Welcome to Chapter 9, Costing Methods. In this chapter in Costing Methods, we'll see that it's basically a catch-all for the different types of products that we've not yet covered. What we've looked at in previous chapters is we considered absorption costing and marginal costing in relation to the production of units. So that's where goods have gone through a manufacturing process and an actual item or a unit has been able to be valued at the end. We also considered process costing, where we were unable to value a product until its point of separation. And what we're going to look at in this chapter are a number of different areas. We're going to consider costing for a one-off job. We're going to look at costing where goods have been produced together in a batch. We'll then move on to the service industry and consider some of the issues that we need to look at for service operation costs. We'll also think back to process costing, and we'll see that you could be asked to distinguish or value between byproducts and joint products. And then we'll look at a number of different costing areas that you could be asked to explain or differentiate between in the exam, specifically activity-based costing, target costing, life cycle costing, and total quality management. So you'll see that in this chapter we're going to cover a lot of different areas, and again these areas could appear in section A of the exam. Let's look at it in a little bit more detail on your summary diagram over the page.
Here we're going to be looking at how to do batch costing for items that are produced in groups and also for one-off jobs in particular industries. We're also going to be looking at how we can account for costing in service industries, and we're going to think a little bit about service departments within organisations and how to charge for those. Following on from process costing as well, we're going to be thinking about how to deal with production processes that produce more than one product, i.e. those with joint products. We should also be looking at some alternatives to traditional absorption and marginal costing. So we're going to be looking at activity-based costing, total quality management, life cycle costing, and target costing within the chapter. For these alternative costing principles, though, you're not going to be required to undertake calculations. You just need a knowledge of them, an awareness of them, so you can answer knowledge-based questions. So let's just begin by defining what we mean by a job. A job then is a cost unit for a single order or contract. Every single job is separately identifiable, and so are the costs that can be attributed to each of those jobs. They're usually pretty large in nature, and the example here is construction of a rail link. The company then that was costing this would be able to look at the cranes and diggers they needed to hire for this, the labour costs and the material costs attributable to that rail link. A batch then is when we're producing items which are too small to work out the cost of one individual unit. So for example then it's a group of identical items, for example 10,000 disposable razors. A company wouldn't be concerned with just producing one. Before we have a look at some numbers then, let's think about the sorts of businesses that might be using job costing. So you might expect it to be used by a plumber. So if they were coming to work out the cost of a new central heating system, they would look at the cost specific to providing the service for you. You might also see it used for a builder, so the cost of your extension or your building project. And also engineering companies, so following on from the example of the rail link. So usually then going to be big jobs, and it's worth identifying the cost of these separately. The process for this then involves a cost card being drawn up for each job or the batch using either absorption costing or marginal costing principles. And the card for a job, a cost card for the job would look like this. It would have the job name, and as before we'd have all of the prime costs, so all of the costs that are directly attributable to the job, and then we'd have any overhead costs to give the total costs. Depending on the organisation's policies, non-production overheads might also be included when estimates of the cost of the job are produced. Here then we're looking at the total cost of this job X112. So we need to set up a cost card then to give us the total cost. We've got information about the cost of materials and also of labour, but note that the labour cost is in hours, so we'll need to translate that into a financial amount. We also have variable overheads of $2 for every labour hour, and we've got some fixed overheads as well to consider. And because we're asked for the total cost, we are going to include those fixed overheads. So that's probably the first decision you'll find yourself considering in the exam. Should I include the fixed overheads? Well, as we're looking for the total cost, the answer is yes. If it had been the prime cost, then we wouldn't have included the overheads. So I'm going to set up my cost card here for this job X112. So we've got materials here then which are going to cost $1,350, and we've got labour at $6 per hour. So we've got labour costs of $900. We also have variable overheads of $2 for every hour that labour works. So that's another $300. And that would give us a prime cost of $2,550. But we don't need to stop there. Make sure you don't get distracted by 2,550 because it's bound to be one of the multiple choice answers. We need to also add in the fixed overheads, which are absorbed at a rate of $3 per labour hour. So that's an additional $450, taking the total cost to $3,000. What about things going wrong? Well, inevitably they will sometimes, and if we have substandard output, then we might incur rectification costs to put that right, to fix the damage. There are two different categories then of these rectification costs. So, for example, those which are not a frequent occurrence, and they will be a direct cost to the job. And sometimes there will be rectification work that does frequently occur, and that will be treated as a production overhead. So, for example, if the builder knows that in 1 out of 5 cases when they replaster the wall, they'll have to go back and touch up some cracks, then that's going to be treated as a production overhead. If something goes drastically wrong, like bursting a water main, we'd hope that wasn't a frequent occurrence, and the cost of fixing that would be charged specifically to the job where the burst water main occurred. Next, we move on to costing within service industries, and we begin in lecture example 3 by coming up with some examples then of service organisations. This list is by no means exhaustive because there are lots of different types of service organisations. Probably the one that you're most familiar with, because many of you will work for one, is an accountancy firm. They don't provide tangible output, they are providing a service. Same could also be said of a law firm, so providing legal advice, and perhaps an advertising company or advertising agency. All of those are providing services. Equally, you might have charities and government agencies as well providing services. In part B then, we need to think about what it is that makes service organisations different to manufacturing organisations. And I've already alluded to the first one really, which is that with manufacturing there is a tangible output. So there is a product that you can touch, that you can feel. However, with service industries, the output is often intangible. If you consider something like legal or financial advice, it's intangible, it's worth more than the piece of paper which it's written on. Most of the costs then are going to be indirect. So I worked as a financial services auditor for many years before joining BPP, and at the end of months and months of work we would provide the client with a signed copy of the accounts. The paper that was printed on cost a few pence, but it costs in some cases hundreds of thousands of pounds to produce that audit report and that signature on those accounts. So a lot of the costs there indirect. If you think about manufacturing a table or some other item, a lot of the costs are going to be directly attributable because they are going to perhaps be for materials and other direct costs. In manufacturing then, it's also easier to identify what your cost unit is. It could be one particular unit or it could be a batch. Sometimes as well you can build up stocks of those items as well for the time of year when you're perhaps going to be busier. So in the run up to Christmas, toy manufacturers building up stocks of toys. With a service then, it's very difficult to identify what the service is. Is it an hour of accountancy time? Is it assigned accounts? Also, it can't be stored. So you can't build up stocks when you're going to be busier. You have to deliver it at the same time as the consumer consumes it. The other thing then is that when we're thinking about services and manufacturing, we need to consider the distinction between those products that are homogeneous, so all the same, which is going to be the case in manufacturing. If we're mass producing, all of the items that come off the production process will be the same. With a service though, there's heterogeneity. It's going to be dependent on the person delivering the service. So the financial advice, the doctor's opinion is going to be different in every single case, depending on the facts of that case. And we can summarise the differences here using SHIP. So simultaneous production and consumption. So one of the things about that is it cannot be inspected for quality in advance. Heterogeneity, so all the services will be slightly different each time because they're reliant on people who are not robots. As I said, the service is intangible. You can't kick it, you can't touch it, and it's perishable, you can't store it. So here they give the example of the hairdresser storing up the cuts in advance. As a starting point for costing in the service industry then, although it's difficult, we need to identify what would be suitable cost units. And we've got some examples here then of companies in the service industry that we need to think of cost units for. So for a hotel, it might look at the cost of providing an occupied bed night. So what's the cost involved in providing a night's accommodation? In education, we might look at the cost per full-time student, or you might look at the cost per tutor or the cost per course. For hospital, you might look at the cost per patient per day. And for catering establishments, you might look at the cost per meal or the cost per customer served. Once we've identified what our cost unit is, we can work out the cost per unit. And you need to learn the formula for this. It's quite straightforward. It's the total costs in the period divided by the number of service units. So for example, the total cost of running the hotel divided by the number of occupied bed nights. And we'll be able to use this as a basis for working out how much to charge our customers. So we'll add an amount to the cost per unit to give us the selling price, bearing in mind how much profit is required. The cost per unit then is important because it affects the selling price and that might affect the competitiveness of the organisation. In some types of services then, it's not going to be appropriate to use a single cost measure. So we might use a composite cost unit. For example, if we're thinking about excess baggage, it's going to be dependent on two things: the distance and the weight of the baggage. Both of these have an impact on the airline's fuel cost, and so we can't just base it on one of those criteria. So we'll end up working out a cost per kilogram per kilometre, and that will be used then for charging for excess baggage. I'm sure, as we know, they will then add a profit to that to come up with the charge they delivered to customers. In worked example 1 then, we're going to be working out the cost of carrying an extra 2 kilograms for 5,000 kilometres. There are $6 million of extra costs for excess baggage, so for example extra fuel, and this excess baggage has been carried for 25,000 kilometres and there's 32,000 kilograms of it. We're going to work out a composite cost unit, so a cost per kilogram per kilometre. So we need to share our $6 million of costs between our 32,000 kilograms and 25,000 kilometres. So we end up with a cost of just under a cent per kilogram per kilometre. So 0.75 cents. The cost then for 2 kilograms going for 5,000 kilometres will be 0.0075 times by the 2 kilograms times by the 5,000 kilometres. So that will give us a cost of $75, and that will be the basis for charging. As well as charging for external services, we might also charge for internal services. So service departmental costing can help us to work out how much we should charge for an internal service. So that could be something like the canteen, the service centres we've seen before, or it could be support services like data processing. The reason then for doing this is to control costs and efficiency in the service department, because they're accountable for how much they spend, and also to control the costs of the user department to prevent excess use of those services. So how can we charge for these? Well, we could decide that actually we won't make any charge at all because the service centre is fundamental. So for example, something like IT support. We might do it at actual cost for something like the canteen, or we might use some kind of absorption costing, which looks at the full cost, or we might do it at the variable costs. Alternatively, we might think about opportunity costs. So what have we foregone, perhaps in terms of external sales, in order to fulfill internal demand? Or we might enable the service centre to actually make a profit. When we looked at process costing then, we were using a process to produce one product. In some particular processes though, we might get joint products. So we might have 2 or more products which come as a result of the same process. But what's important here, and why we use process costing, is because they're not separately identifiable until the point of separation. In order to be classified as a joint product, it must have a substantial sales value, either at the point of separation or once it's been processed further. So if we look at the example up here of forestry, once the logs have been collected, they have a use then, 2 potential uses: paper and wood for construction or building. We might also get a byproduct from logging, which is sawdust. Byproducts then are an incidental production because they've got relatively low sales value compared to the main product, and they're not the purpose of the production process. So you don't cut down trees to get this sawdust, but it is produced at the same time and it does have a small sales value, perhaps the sawdust being used for animal bedding. So the important thing about a byproduct is that it's secondary to the main process. Before we have a look at the treatment of byproducts and joint products, we're just going to think of some examples. So examples then of production processes with joint products and byproducts. We've already seen then the sawmill, so we get the timber and the paper and also the sawdust. And there will be some further processing there. For example, the timber may need to be planed and the paper will need to be made from the pulp. We could also have a chicken farm. So the joint products will be things like the chicken breasts, the legs and the wings. All of those are going to be joint products. We can't rear the chicken for just the expensive parts. We need to have all of the different bits. One of the byproducts then could be waste from the chicken. Also, if we have oil refining, we can't separately identify the diesel and the petrol until the point of separation. And we might also produce paraffin from that refining process. So you don't need to understand how the processes work or anything like that. You just need to know that they are producing joint products, so petrol and diesel, very similar sales value, and then also those byproducts, so for example the paraffin. So how do we treat these? How do we account for them? Well, if it's a byproduct, then we're not going to allocate joint costs to them because a byproduct is effectively very similar to a normal loss. So we're not going to allocate the joint cost to them. If it's a usual occurrence, then if there are net proceeds, we'll use them to reduce the process costs. So if it's usual, we'll treat it as a normal loss. If it's a one-off that we weren't expecting, so it's something that doesn't regularly happen, unlike sawdust, then we can treat it as miscellaneous income. With our joint products then, we can't identify them until the separation point, so all of the common costs incurred, so those costs in the process account, will need to be apportioned in some way between the products. And we might use physical units. So in the case of the petrol and diesel, we could allocate it the cost based on the number of litres of output, or we could do it based on a relative sales value. So apportion the common costs on the basis of the proportion of the total sales value. And if the process itself is profitable, it will ensure that all of the products produced by the joint process are profitable. So in example 6 then, we have a process with two products, P1 and P2 as the output, as well as a byproduct. And what we have to do is to allocate the joint costs on a physical units basis. So the first thing we need to do then is to work out what those joint costs are. And there's several ways that you can do this. I'm going to do it via a process costing T account. So we've got then materials, and we've got 2,000 units of materials which cost $2,000. We've also got labour costs of 2,000 and overheads of 1,000. So we've got total costs then of $5,000 for the 2,000 units. However, we have this byproduct and it does have a value. So we've got 200 units of byproduct of normal loss with a value of $50. So in terms then of our costs, we've got 5,000 less the $50 of scrap value, and we've got 2,000 units of input and 200 units of scrap, so that's 1,800 units. So that's going to give me a cost per unit, $2.75. For product 1, we've got 600 units, and for product 2, we've got 1,200 units. So the amount of costs then that's going to be allocated to P1 will be 1,650. That's basically 600 over 1,800 times by the process costs as a shortcut. And for P2, it's going to be 1,200 lots of 275. That's 3,300. So it's a proportion calculation that we're doing. As I said then, as a shortcut, you can look at the process costs less the scrap value of the normal loss and then do it as a proportion calculation, as it's likely the question would ask you to work out the cost for one of the joint products. In part B, we're going to assume that the products can be sold immediately. P1 for $2 and P2 for $5. So what we have to do then is we need to think about how we're going to apportion those costs on the basis of sales value. So we've got then the costs of $4,950, and we need to have a look at the sales. So $2 per unit, and we have 600 units. So that's going to be $1,200 of sales revenue for P1, and for P2, $5 per unit, and we have 1,200 units. So that's going to give sales revenue of 6,000. So we've got $7,200 of sales revenue. So we need to allocate those $4,950 of costs proportionately. So for P1, the costs will be $1,200 out of $7,200 to be allocated. So we're looking at 16 2/3% being for P1, which gives us $825 of cost to allocate to P1, and the rest is going to go to P2. So 6,000 divided by 7,200 multiplied by the 4,950 gives us $4,125 per unit. If we just continue this, then the amount of profit that we will make will be 375 for P1 and 1875 for P2. And what you'll notice is that the profit margin percentage is the same for both of the products because we've used this relative sales price to work out the proportion of costs to allocate. So if we look at the profit then and relative sales value, we've got 375 for product 1 and 1875 for product 2. However, what about if we use the physical measurement to apportion the cost, so the amount of output? Well, we'll still have the same sales value for each of the products because it's $2 for P1 and $5 for P2. The cost that we calculated in part A were 1,650 for P1 and 3,300 for P2. So what that means then is we end up with a loss of $450 for P1 and a profit of 2,700 for P2. So the overall profit is the same. It's just the distribution of that profit that's different. And as I said before, if you use the relative sales value as a way of apportioning the costs, then you're guaranteeing that if the joint process is profitable, that the individual products will be. And that is why we have to think about the differences between the two types of units. So the physical units is useful if they're both in the same form, so diesel and petrol, and if they are components in another product that don't have a relevant sales value. The relative sales value is useful if we want to ensure that all of the profits are profitable, and it's good if they're going to be sold straight away because we won't have any extra selling costs and we'll know what they are worth. It's also useful when they're not in a comparable form of output. Example 7 then is similar to something which was seen on the pilot paper. So we've got a product process with two products, S and T, being created from it. S is being sold immediately after split off, but T needs processing further to make product TT before it can actually be sold. There are no opening inventories and closing WIP to deal with, and we've got some information about the products and the processes for the last period. So we've got processing costs then of the whole process of 262,500, and we've got additional costs to make T into the TT of 49,500. We're also given information then about the number of units produced of each of the products and the closing inventory. So it's not work in progress, but it's unsold inventory. And we're going to use the physical unit method to apportion the joint costs, and we need to work out what is the total value of this closing inventory of TT for the last period. So although we've got 22,500 units of closing inventory of TT, we need to base our calculations on the number of units that were produced. So in total, the number of units that were produced are 562,500 units. So of the joint process costs of 262,500, 247,500 out of 562,500 will be allocated to TT. So that's 115,500. But we also need to deal with the further processing costs of 49,500 to give us the total cost of producing all of the TTs. So it cost 165,000 to produce all of the TTs, and at the end we've got 22,500 out of production of 47,500. So that's going to be 15,000 as the value of closing inventory. So when faced with a question like this, you need to work methodically through the steps, remembering that the units that are produced is the number that you're going to be working on to work out the cost per unit, and then you need to look at the total costs for this product TT and think about how much is left compared to how many were produced, what proportion of units left. The next section concerns itself with some alternatives to absorption costing and marginal costing. Calculations are not required for these in F2, but you need to be able to answer knowledge-based discursive questions on the topics. So first of all then we've got activity-based costing, or ABC, and it was devised then to overcome some of the problems of costing products in the modern manufacturing environment. So if we cast our mind back to absorption costing, it uses one basis for absorbing all of the overheads for a particular department or cost centre. And the business chose the way then that reflected the way the overheads were being incurred. So you can see here then in the example that most of the costs in production department A relate to machine hours, and so the overhead absorption rate would be done on the basis of machine hours. What that means then is that the supervisor's salary and the production setup costs, which weren't really dependent on the number of hours worked, were going to be used as the basis for absorbing the overheads. Activity-based costing comes in then because actually not all of the overheads are volume related. So the production costs, setup costs, will be the same whether you set the machine up to produce 1 unit or 1 million units. And so actually advocates of ABC argue that one basis for absorbing overheads doesn't reflect the complexity of producing some products rather than others. And so what we have with ABC is multiple overhead absorption rates. So ABC is a type of absorption costing, but it thinks about each cost individually and what causes it to occur. So for example, the production setup costs will rise the more times you set the machine up. So the cost driver is going to be the number of setups. Machine hours is the best basis for machine oil and repairs, so that will be the cost driver there. But for supervisor's salary, that's going to be dependent on the number of hours that labour is actually working. So the steps involved in activity-based costing then are first of all to group all of your overheads together into cost pools. Think about the cost drivers, so what it is that causes those costs to be incurred, and then work out a cost per unit of each of the cost drivers and absorb those costs based on usage of the cost driver. So if you're costing a product, look at the number of machine hours, look at the number of labour hours, etc. The benefits of using ABC over absorption costing are that you should end up with a cost that's more closely linked to the actual cause of the overheads. And this is more important when businesses have much wider product ranges and when we've got shorter product life cycles. More about product life cycles in a moment. And the reason this is the case is because ABC enables you to consider the complexity and diversity through the multiple cost drivers. TQM then, or total quality management, is a philosophy. So it's an idea then which aims to improve quality. And the process then, or the ethos of TQM, is ensuring that you get it right and you get it right first time. And the way that comes about then is managing the quality of the process by having standards for quality for a product or a service, so number of reject rates. And then making sure that you've got procedures in place or ways of producing products to make sure that most of the time this level of quality will be achieved. We also need to monitor the actual quality, so if you've set a target of 1 unit per million being defective, measuring that to make sure that it's the case, and taking some control action if quality is below standard. So as I said, the philosophy then is get it right first time. It's cheaper to prevent mistakes than it is to correct them if they occur. Continuous improvement as well is also important in TQM, so we're always looking for ways to improve rather than accepting the current level of quality. When we're looking at performance measures for TQM, we shouldn't simply be confined to the production process, because TQM should embrace every activity of the organisation. And often we're going to use non-financial performance measures to ensure that this level of quality that's required is actually obtained. And we think about non-financial performance measures later on in the course. But some examples here then, if you're looking at quality, complaints, warranty claims and defective production would be examples then of non-financial indicators for performance. The next thing that we're going to consider is life cycle costing. Here we're aiming to look at all of the costs and revenues incurred through the entire life cycle of the product. The idea is then that if we know all of the costs and we can compare that to the anticipated total return of the product, that we can assess its viability. Also, because life cycle costing is considered up front, we can make changes to the product design to perhaps try and reduce those costs, or look at ways of extending the life cycle so that we can ensure profitability is forecast. So the product life cycle itself then is divided into 5 different stages. In the development phase, the product will be, as the name suggests, developed, so R&D type activities will be undertaken. And you can see here then there's no sales revenue because the product isn't available on the market. And instead of being a profit, we actually end up with a loss because we've got all of the costs associated with incurring the development. As we move into the different phases then of introduction, we start to see revenues rising, and this continues through the growth phase, and eventually they'll plateau off in the maturity phase where sales can no longer be increased, and eventually they'll peter off into decline. Profitability then will lag from sales revenue because initially then there'll be lots of costs to be incurred. For example, fixed overheads for investment and marketing, telling people about the new products, and also getting the production facilities up and running. So what you can see down here then in the table is we've got the characteristics of the different stages of the product life cycle and the different types of costs. What you'll also notice then is that on the time axis there is no time frame because it will be entirely dependent on the product. Some high-tech products will have a very short product life cycle. So for example, iPads being replaced already by the iPad Airs. Some products though, like Kellogg's Cornflakes, having a much longer product life cycle, having been in maturity for many years. Following on from shorter product life cycles where new products are constantly being developed, we have this next concept of target costing. And with target costing, what we're trying to do is achieve a target cost during the development phase. So right at the beginning, we're trying to ensure that the product can be made for an amount of money which is going to see that a certain level of return will be generated. And this is an alternative to the cost plus pricing strategy. So historically then, businesses will calculate how much it costs to make the product, and then they'll add a markup in order to give the selling price. The problem with this though is that it doesn't think about external influences on the selling price. So for example, how many competitors there are and what they're charging and what your customers are prepared to pay. The problems are then that we're not thinking externally, and so it's not going to result in the maximisation of the company's profits. Target costing though looks at it from a different viewpoint. So we're starting with a selling price. So with target costing, we're setting the selling price, then taking off the profit margin, and the difference will leave you with a target cost. And the company has to ensure that it can manufacture the product at that target cost in order for the product to be viable. So you can see diagrammatically here then that we've got this traditional idea that the selling price comes last because you begin with the cost and add your markup to that. With target costing, you start off with your selling price, take off your markup, and then you're left with a target cost. And the question for the company is, can I manufacture a quality product or a product with sufficient quality to meet consumer needs at a price that is going to see profit generated but also be satisfactory to customers? Here then we've got all of the stages involved in implementing the target cost. And we start off by thinking about the characteristics of the product. So what specifications do we need and what sales volume is that going to result in? The company then will set a selling price which is then going to enable them to achieve that volume. And then we're going to think about how much profit has to be earned per unit based on the required profit margins or the return on investment of the company. And we see that formula then of selling price less profit equals target cost. What we're going to do at the same time then is estimate how much it's going to actually cost us to manufacture the product in the same way that companies would under the traditional method. So you've now got a target cost and an estimated cost of production, and you need to look at the difference between those. And the difference between them is known as the cost gap. And the idea is that in order for the product to be viable at the design phase of the product life cycle, these costs will be designed out. So perhaps reduce the number of parts or reduce some of the aspect of the product without detracting from this specification from the use value of the product. A company which use target costing quite extensively is IKEA. So they think about the functions of their product, what their items of furniture have to do, and how many they'll be able to sell at a given price. And then they set about ensuring that they can manufacture a product of appropriate quality and durability for that target cost, even if that involves tweaking the original design if the estimated cost is too high. In summary then, in this chapter, we've had a look at job costing for when we're looking at individual projects undertaken to the customer's special requirements, and also batch costing when we've got lots of identical items being produced in a group. And with a batch then, because they're all identical, we're treating it as a single job or a single cost unit. Service industry costing then is when we're looking at a service that's being provided. And remember, we've got those different characteristics of service industry companies. So the products and the services being different. So we can remember those with SHIP. Simultaneous production and consumption, heterogeneity, or all of the different services being different, intangibility and perishability. And quite often, because of the characteristics of those services, we'll need to use a composite cost unit. And in the chapter, remember, we looked at the cost for excess baggage being related to the distance travelled as well as the weight. Service department costing can also be applied to internal services such as IT support. Following on from what we saw of process costing, we can look at joint products when we've got to consider whether or not to process something from a joint process further. So we're looking then at how to split the costs between different products from the same process. So for example, petrol and diesel, and the fact that byproducts such as paraffin will be treated as a normal loss. So joint products, we need to find some way of apportioning the share of costs, and the methods we looked at were physical units but also sales value. We then had a look at some modern costing techniques, and for these 4 techniques you're not going to be required to do calculations at F2. That comes later on in your ACCA studies, but you do need to know what we mean by them. So with activity-based costing, we are looking at grouping our overheads together into different activities or cost pools and identifying what it is that causes those costs to be incurred. And that's known as a cost driver. And then we're going to work out multiple overhead absorption rates to get those fixed overheads into the units of production. The idea is then that it's going to be more reliable than traditional absorption costing because we're thinking about what causes the individual cost rather than using a single rate. Next we saw TQM. TQM, or Total Quality Manufacturing, is aiming to improve quality with this idea that you need to get it right and get it right first time, and that businesses must look for continuous improvement, so shouldn't rest on their laurels. Then we saw life cycle costing, which rather than looking on an accounting period or a periodic basis, considers all of the costs and all of the revenues that were generated through the entire life cycle of the product as a way of assessing its viability. Linked into this then is this idea of target costing, that you can design out unnecessary costs by understanding what your customers are prepared to pay for and working out a cost that you must be able to manufacture the product for in order for it to be viable.